What if your financial future was decided by a number you never agreed to, never negotiated, and maybe don't fully understand? A number that quietly determines whether you get approved or denied, whether you pay more or less, whether opportunities open or close. This number doesn't know your story. It doesn't know your intentions. It doesn't know what you've been through. And yet, it plays a major role in your life. So what exactly is this number, and how does it control your options? In real life, you are more than numbers. You have experiences, habits, judgment calls, moments where things went right and moments where they didn't. You can be responsible, hardworking, careful with money, and still struggle at times. But inside the financial system, none of that exists directly. Instead, you are represented by something else, a financial identity. This identity isn't built from your intentions, it's built from data, your payment history, your debts, how much credit you use, how long your accounts have existed, how often you apply for new credit. All of that information gets compressed, simplified, and translated into a single number, your credit score. And here's the key thing to understand. Your credit score is not a reflection of who you are. It's a prediction of how you might behave. Not certainty, not judgment, just probability. From the system's perspective, it's asking one question. How risky does this person look compared to everyone else? That question exists because banks and lenders operate on a simple reality. They lend money. They expect it back. They can't personally evaluate millions of people. They can't interview everyone. They can't investigate context at scale. So instead, they rely on models, mathematical systems designed to predict risk. These models are trained on patterns from millions of past borrowers. They look at behaviors like who tends to repay loans on time, who tends to miss payments, who carries high balances, and who defaults altogether. Over time, the model learns correlations, not reasons, not stories, just outcomes. And based on how closely your behavior matches those historical patterns, the system assigns a score. The higher the score, the lower the perceived risk. The lower the score, the higher the perceived risk. Notice what's missing here. There's no emotional judgment, no understanding of circumstance, no room for explanation. The system doesn't care why something happened. If people with similar data patterns have struggled to repay loans in the past, the system assumes you might too, even if your situation is completely different. This isn't personal, it's statistical, efficient for institutions, but blunt for individuals. Now, this is where the number stops being abstract and starts shaping your reality, because your credit score doesn't just sit on a report, it directly affects your options. With a higher score, you're more likely to get approved. You're offered lower interest rates, higher credit limits, more flexibility. With a lower score, you face more friction, loan rejections, higher interest rates, smaller limits, extra requirements. And sometimes it reaches beyond loans. Landlords may check it when you apply for an apartment. Utility companies may require deposits. Certain services may restrict what plans you're allowed to use. So two people with the same income, the same job, and the same goals can experience completely different outcomes, not because of who they are, but because of how they are scored. That's the power of this system. It doesn't force decisions. It filters possibilities. It quietly determines what becomes available and what doesn't. And because the score is built on patterns, every action you take feeds that pattern. Paying on time builds consistency. Missing a payment creates a risk signal. Using a large portion of your available credit can make you appear overextended, even if you plan to pay it off. Applying for many new accounts in a short time can signal instability or stress. None of these actions exist in isolation. They accumulate, and they don't disappear overnight. They stay in your credit history, sometimes for years. Because the system isn't focused on today, it's focused on trends. How you behave over time matters more than any single moment. Consistency matters more than perfection. But that also means small mistakes can have outsized effects, especially if they break a long pattern of stability. A strong score can fall quickly. Recovery takes longer. And this brings us to the most unsettling part of the system. You rarely see it working. There's no clear explanation in the moment, no message that says you were denied because of this exact behavior. There's no conversation, no negotiation, just outcomes. Approved or not, priced low or expensive. And behind those outcomes is a number, quietly shaping your path. If that feels uncomfortable, it should, because one small mistake doesn't just vanish, it can follow you for years. A single late payment can echo longer than you expect. And that's exactly what we're exploring next. Why one late payment follows you for years. After all, we're just asking, aren't we?